A home equity reverse mortgage, or what we call a HECM, is a Federal Housing Authority insured reverse mortgage issued by the Department of Housing and Urban Development through approved lenders nationwide. It is intended for borrowers who are aged 62 years or older. It has unique features that make the HECM a valuable tool in retirement planning and for aging in place. In this video, we're going to take a look at how you can qualify for a HECM. So how does one qualify for a HECM? If you are entitled and therefore your name is on the mortgage, you must both, if you are married, be age 62 or older. A non-borrowing spouse who is not on the title can be younger than 62, and the amount of the HECM will be based on that younger age. You should both be U.S. citizens. You should own a primary residence or be buying a primary residence with a HECM for purchase. This does not work on vacation homes, investment properties, and the like. It is intended only for primary residences where you will occupy the home. You must have sufficient equity in that home, usually at least 50%, but this level declines the older the youngest borrower is, or increases the younger a non-borrowing spouse is. Do the independent counseling. In this matter, you talk with a HUD-approved, independent from the lender, counselor. And you have to pass the financial assessment, which we'll discuss on the next page. What is the financial assessment and why do you need to pass it? Well, it consists of the lender evaluating your financial willingness and capacity to take on the obligations of a HECM loan. You need to demonstrate your willingness to meet your obligations. Basically, willingness means your past behavior is demonstrated by any past delinquencies. A credit score is generally not required or even considered. In general, you should have had no delinquencies and obligations in the last 24 months, absent some very minor ones, and have always paid your taxes and insurance on time with no penalties in the last 24 months, unless you have a reasonable and isolated excuse. We will look at delinquencies in more detail in a later slide. Capacity refers to your ability to meet your financial obligations and annual property charges, such as taxes, flood or hazard insurance, maybe even homeowner association dues and land leases if they're involved. The standard is that the borrowers meet the Veteran Affairs minimum residual income tables, which are much lower than the income required on a forward mortgage. This standard is based on your family size and where you live in the country. And you must also be able to pay off all your existing obligations that are past due to the federal government or are outstanding liens on your homes, such as a first mortgage or an existing home equity line of credit. HECMs rarely allow a previous lien on the home to stay unpaid. So what is borrower willingness? Well, there's no minimum credit score required on a home equity conversion mortgage. You need to have demonstrated that on revolving credit, such as car loans or credit cards, you didn't have any more than 3 60-day late payments or any more than 1 90-day late payment in the last 12 months. And on installment and mortgage loans, that you made all the payments for the last 12 months and had no more than 2 times 30-day late payments in months 13 to 24. This standard applies to all properties, retained second homes, rentals, etc. And that all property taxes were paid current in the last 24 months for each property you plan to retain after you get the HECM, including the primary residence you're obtaining a HECM loan on. The next requirement that you must meet is the minimum residual monthly income required. One of the great advantages of a HECM is that the income requirements are far less than a traditional forward loan. What is minimum residual income? Well, residual income is what cash you have left over from your monthly income after you've met all of your financial obligations, including property taxes and insurance and any other property charges, any payments on installment or revolving credits, the payment of income taxes, and similar type obligations. The residual income is based on the U.S. Department of Veteran Affairs residual income tables, which vary depending on the region of the country you live in and how many dependents are in your family. The more dependents you have, the larger the minimum income required. What is a dependent? Well, it's someone who lives in the house with you. You can see the Northeast residual income displayed on the slide. If the second person is your spouse and they're on title, his or her income can be also added to the total family income. If you have additional dependents in the house, if any of those dependents have their own income in excess of the minimum residual income required for an individual, for the purpose of getting the HECM, you can exclude them from the calculation. Always remember, with a HECM, the unused portion of the line of credit can itself help you meet the residual income requirement. We can spread it over the remaining life of the youngest borrower and call it income. We're going to talk about a feature of the HECM that forward mortgages generally don't have, or it's very rare. It's called asset dissipation. In the forward world, if you had an investment of $50,000, we would look at the return on that investment and consider that income for the purposes of the ratio qualifications. However, in the HECM world, we actually look at the $50,000 and spread that principal amount over our estimate of your remaining life. And that principal amount that we calculate is included in your monthly income. Let me give you an example. You can see what we're talking about. Suppose you're 70 years old, Social Security at $1,200 a month, $400 of monthly car and consumer debt payments. You own your own home, it's worth $350, you have no debt, you have an IRA of $50,000, and you've got monthly tax insurance of $500. And the home is 1,400 square foot in size. We need the 1,400 square foot home, we need the square foot of the home, because we're going to attribute a maintenance to it under the HUD formulas. Your residual income we calculate then is $104 a month. That will be your original $1,200, less monthly obligations of $900, and less the monthly maintenance, which we calculate to be $196. You have a shortfall of $436 from the required monthly residual income of $540. How do you qualify? Where do we find the required shortfall? Well, first we look at dissipating or spreading your IRA savings after tax, because when you receive them you will be taxed, over your estimated remaining life of 15 years or 180 months. So we take the $50,000, we deduct the 15% in tax, and we calculate a monthly dissipation over the 180 months of $236. But still you're short. This calculation still has a deficit of $200 off of the monthly required income. What do we do now? Well, once again, the HECM has got a remarkable feature. We can dissipate the unused HECM proceeds. At 70, you qualified for a HECM of 58% of home value or $197,200. In this case, your proceeds are tax-free and after costs, which we estimate to be around $10,000, and you had no mortgage to pay off, we spread the available and unused HECM of $187,200 over 180 months, and we get $1,040 per month. We can call that $1,040 actual income for the purposes of meeting the minimum residual income. So as you can see, the actual HECM itself, depending on the availability of the unused proceeds, the HECM itself can actually make up the monthly residual income. If you want to learn more about reverse mortgages, go to Amazon.com and find the ebook Reverse Mortgages for Retirement. It's got about 130 questions and answers on the most important aspects of reverse mortgages. Or if you like, reach out to me and I'll send you a copy. I also recommend you go to our website, jmcapitalreverse.com. It's loaded with information for both professionals and for consumers. Finally, if you think I can help you, reach out to me at my email or call me on my cell phone. I'd be delighted to answer any questions you have. I hope you have found this video helpful.